18 months. It's been 18 months since the Indian stock market has not generated any returns. In fact, Nifty has corrected around 1000 points since its peak in October 21. And today, Nifty is at levels that it's achieved in September 21. And the condition is even worse in mid-cap and small-cap space. Today, we can clearly see deep pessimism in the market. Many people are now losing out their patience and interest in stock market. Especially the young folks that started their journey in 2021 are in deep panic with their complete portfolio in red. And the worst part is there is no hope of recovery, at least in the near term. So I thought of creating this video to share my perspective on current market situation and share my viewpoint as a long-term fundamental investor. So first of all, we will discuss three factors that have created deep pessimism in the stock market. These three factors are crucial for the market and will decide whether Nifty will fall below levels of 17,000 or will it cross 18,000 in the near future. And then I'll share some of the other insights that I have identified from the market. Based on the factors, I'll share my investment strategy in current market. But before we proceed, needless to say, this video is only for long-term investor, not for traders. Alright, let's get started. So the first factor that has resulted in deep pessimism in the Indian market is high interest rates, especially in the US. We have already discussed in the past about how near zero interest rates during COVID resulted in crazy liquidity in the US economy, and that resulted in huge FIIs inflow in Indian stock market. Hence, the Indian market zoomed exponentially in 2021. But when US economy started opening up post-COVID, people started revenge shopping and spent their money crazily. That resulted in everything getting costly and hence created crazy inflation in US. In order to control that inflation, US Fed increased the interest rates multiple times in 2022. Now currently if we look at the inflation data, US inflation is at 6.4% in January 23, which is lower than the highs of 9.1%, but still much higher than the US Fed limit of inflation below 2%. And recently US Fed has published the minutes of meeting where they have clearly indicated about further increase in interest rates. And that has disappointed the street. So the pain in US economy would still continue due to higher interest rates because you get loans at much higher rates and everything becomes costly. Eventually that would help in fall in inflation, but it would impact the economic growth in the US as well. Now we have already seen many news around job cuts in the US, and since a lot of FI money flows from US into the Indian market, we are also impacted with high interest rates in the US. Now I was looking at one of the report from Goldman Sachs and they are anticipating 3 more rate hikes in 2023. So from current levels of around 4.5 to 4.75% interest rate, the interest rates in the US can touch levels of 5.25% to 5.5%. And there is no sign of rate cuts in 2023. But remember that stock market is always forward looking. So a lot of people are asking, when will the upward trend start in the market? On that, my take is that the upward trend in the stock market will only start when the market will get a hint of no further rate hikes. But it will take a few months, maybe around 3 to 6 months from here. So the next 3 to 6 months can still be painful. Then second factor impacting the stock market is geopolitical tension. It's been entire 1 year since the war between Ukraine and Russia, and that has still not come to any conclusion. In between, there are also news regarding use of nuclear weapon and all of that. So that has also kept the stock markets on the edge. Going forward, this geopolitical issue will also drive the stock market movement. A good news can be positive for the market, while bad news can result in further correction. And nobody can predict the time frame for this event. Then third factor that has impacted the Indian stock market is the Adani saga and the ill effects. After the Hindenburg report has come out, Adani group of stocks have fallen like a house of cards and they are down in the range of 50 to 80%. Mind you, Adani group of companies are not small cap stocks. Majority of them are large cap and hence this correction is on huge scale. For instance, Adani Green is down 82% from its peak. Adani Enterprises is down 57%, Adani Power down 61%, Transmission down 82%, Adani Gas down 80%, Adani Wilmar down 50%, Adani Port down 31%. After the Hindenburg report, the collective wealth destruction in Adani Group is in the range of 10 to 12 lakh crore rupees. That's almost equivalent to total market cap of Asian Paints, Titan, Wipro, Nestle, Tata Motors, Mahindra & Mahindra, Divis Lab, all put together. So you can imagine how bad that is. However, I strongly believe that no single company or group can determine the future of Indian stock market. Even if we quantify the impact of fall in Adani Group on Nifty, it is not that bad in Nifty 50. Although the impact is much higher in Nifty Next 50. So Nifty 50 has two Adani Group of companies, Adani Enterprises and Adani Ports, with a combined weight of 2% before Hindenburg report. In Nifty Next 50, the situation is slightly bad with 14% weightage of Adani Group. Although recently Adani Group companies have shown upward trends. Anyways, it is one of the factors that has resulted in pessimism, but not the most important factor. The important factors are still interest rates and geopolitical issue. Now, I was looking at valuation data along with FI's buying selling pattern and found some interesting insights. Let's have a look. If you look at the last 2 months of FI and DI buying and selling, FIs are clearly on sell mode in 2023. In January, they sold investment worth around 41,000 crore and in February, they sold investment worth around 11,000 crore. Although DIs did provide the support with buying worth 33,000 crore in January 23 and around 19,000 crore in February 23, however, net there is selling, and that is the key reason why markets are in correction mode. But as a long-term investor, one of the most important parameters to take a buy or sell call is valuation. So I was looking at the index valuation and found interesting information. Currently, Nifty is trading at a PE ratio of 20.4. Nifty Midcap 150 PE ratio is 24.2 and Nifty Small Cap 250 PE ratio is around in the range of 18, which is even attractive. 18 months ago when market was at similar level, Nifty 50 was trading at a PE ratio of 26. Nifty Midcap 150 PE ratio was 30 and Nifty Small Cap 250 PE ratio was 31. So over the last 18 months, while the stock prices have not jumped, in fact, they've only fallen, the overall earnings have increased. For instance, in Q3, Nifty 50 operating profits have grown at 11.4%, Nifty Midcap 100 operating profits have grown at 13.5%, and Nifty Small Cap 100 operating profits are up by 10.9%. As a result, PE ratio has fallen. So the valuation clearly suggests that Indian markets are available at reasonable valuation, which means it is a good time to invest money in a systematic manner. However, when there is pessimism in the market, some investors like to wait for the recovery in the economy, while some like to wait for further correction. But the problem is, if you wait for the recovery in the economy, chances are high that by the time you realize that economy has recovered, market would already be touching a new highs because stock market is always forward looking. And if you wait for further correction, you might get a better entry point. But our human tendency and mindset is such that when the market falls, we tend to get greedy and we want market to fall further to invest our money. And in majority of cases, those who keep waiting for the correction just can't invest their money. And later, when the market recovers, they regret not investing. So the point here is, there's no perfect time for investment. At this point, the valuations are looking attractive and many individual stocks are available at attractive levels. So the best strategy at this point that I am personally using is buying on dips in a systematic manner over the next 5 to 6 months. Folks, it's been 18 months since the market has not moved and probably few more months of pain ahead. But trust me, 2023 has created the best opportunity of investment in Indian market for long-term investors. Those who have money today and if they don't invest in 2023, then they are going to regret their decision in the future. I strongly feel that the worst is over and it is a matter of few more months as the inflation is already in declining trend. I know that it is difficult to gather courage to invest when the markets are down for 18 months and there is pessimism in the market, but remember that you won't get good news and good price together. In 2021, when the news were good, stock prices were not good. And in 2023, when the news is bad, prices are good. So the current bad news is good for long-term investor to buy quality stocks at attractive valuation. Because you don't make money when you invest during bull run. You make money when you invest during the bear market and when eventually the market gets into the bull run. So that's my viewpoint on the market. Let me know if you resonate with my thought process. And if you have any other viewpoint, I would be happy to know. But of course, only for long-term investors. Moreover, if you want me to cover any specific topic, then also let me know. For more informative content in the future, you can also like, share or subscribe to this channel. I'll see you in next video. Till then, take care.